Hey, everybody. Welcome to the Practical Founders Podcast, where every week we hear an amazing story from a serious founder who built a valuable software company and did it without big funding. I'm your host, Greg Head, and this week my guest is Zvi Band, the former CEO and co-founder of Contactually, a relationship-based CRM that was created in 2011 and grew up to 10 million revenue and was sold in 2019 with some VC funding along the way. Zvi is off building bootstrap software companies these days. He's a technical founder, but he talks about the challenges and the experience of raising VC funding. He eventually sold the company, wasn't a huge win, and he's very honest and open about the challenges for him personally and for the company that they faced along the way, and eventually got to a successful exit for Contactually. It's a great episode. In this episode, Zvi talks about how important it was to have great advisors, to have great board members, to have peer founders that he could rely on for advice about smaller things. How did you do this? Bigger things. We're considering this. Does this make sense? And to stay sane in the process. This is a crazy journey. And normal people with jobs and neighbors don't really understand what entrepreneurs are going through, even if it's been a good year for you. It's always hard. That's why I created the Practical Founders CEO peer groups, for B2B SaaS founders who are building valuable software companies without big funding, like Zvi, to be around other founders every month, and me, to work on the business, to face your hard challenges, to grow as a CEO, as a person, to build a valuable software company, and do it with more sanity every year. It's a difficult game, and we get to do it together. Check out the Practical Founders CEO peer groups at practicalfounders.com. Hey, Zvi, welcome to the Practical Founders Podcast.
Greg, thanks so much for having me today.
Look at you with your relatable hat on here, flying your bootstrap company colors, your new product and everything. Is that a real business or is that like a side project for you?
Both. It is
good.
a side project in that, like, it's not necessarily taking up my full time and attention, but it is a real running profitable business.
Okay.
Speaking of the hats, it was funny when in my first company, which was venture backed.
Yeah.
Yes, we bought hundreds of hats and gave them
Right.
away to employees and
First job, get
customers
the
and
swag.
everyone who walked in the office with Relatable. I was like, I'm going to print 12 hats and give them to the people who I really, really want to have a hat.
Yeah. Yes, I have. I'm way down on the swag, in the last 10 years here, I did the VC funded thing. And of course, we'll talk about Contactually, your VC funded software company, SaaS company, started in 2011 that you sold and stayed with for a year or so. And now you're on to other things here, but you learned a lot of lessons about the growth game, the VC funding game, who you are as a CEO. And, we're going to dive into that journey. Is Relatable your current contact-oriented product, relationship-oriented product? Is that your only venture right now? What else are you doing?
So I'm up to a few different shenanigans. So
Yes.
you were talking about how focus is the F word for many founders, and I am guilty of that too. That being
Okay.
said, I'm intentional about it. So I have Relatable. I also run a small coaching practice for relationship-oriented professionals, and then I'm also CTO of Keep Company, which is a venture-backed, at least small V venture-backed startup in the group coaching space. But Relatable is really my act two. I'm incredibly passionate about relationships. And after my experience with Contactually and the 7.5 years of business school that I had there, I realized I wasn't done. And that's what led me to found Relatable. That being said, I'm doing it in a very different way than before.
Okay, we'll talk about that. It's kind of part of your entrepreneurial journey. But let's talk about Contactually. I actually spent a few calls. I spent most of my career in CRM and contact management. And I spoke to your co-founder, Tony, multiple times through the years, offering focus therapy. Should we be for everybody? Should we be for an industry? How do we think about this? And the rest of it. What can you say about, help describe what Contactually is for the audience?
Yeah, absolutely. And I will call it today. Contactually is a relationship-oriented CRM. I'll say it now because back then we kind of kept playing around with our branding and what are we.
Ah, yes.
That being
Yeah.
said, most CRMs, as you know, Greg, having lost hair similar to me
Yeah.
in the CRM space,
Yes.
most CRMs are focused around sales pipeline or sales engagement or marketing. We were focused on serving relationship-oriented professionals where they needed to stay in touch with relationships over months and years on a continual basis. So, for example, if you're trying to generate referrals from your network, we cared a lot about making sure you were in touch with referral sources. It wasn't just trying to get someone from a lead to a closed client. It was,
The
hey,
funnel in this
let's
quarter's pipeline and all of that. Yeah.
exactly. So instead of like a funnel, imagine a whirlpool. And that's really what
Ah,
Contactually is all about. And we had some pretty cool tricks. We would track all of your email conversations, calendar appointments, Facebook messages, LinkedIn messages, text messages, pull all them into one platform. And then every day we'd be identifying relationships that you may want to re-engage with.
yeah. Well, I've done the CRM software game and the CRM game and the pipeline game, marketing and funnel and closing and customers, so forth. And I've also been in the relationship game, right? My relationships is how we found out about you, and got you on the podcast. And I'm building relationships through the podcast. And I work with tons of partners. And I'm talking to founders all the time. I'm not trying to sell them something. They're not in my funnel, so to speak. But I have a huge, I don't use the word network, but like a huge or even community. I don't think it's like that. But I have a lot of relationships that are trusted and vibrant and important to me that are really not in my funnel, I would say. Is that
Yeah,
what we're
exactly.
talking about?
Oh,
Okay.
absolutely. And that's, I think, one of the key differentiations that for your business, you may have your marketing list and your pipeline of people you're trying to actively pursue a transaction
Right.
with. But then we have this whole other world, frankly, a larger pool, and probably even a more valuable over a long span of time of people that are just important, right? Whether you work together in 3 months, 3 years, never. Maybe it's a referral, maybe it's pinging for advice, maybe it's an introduction to a potential podcast guest, whether it's
Yeah.
from Mindshare or, referrals. There's so many reasons for it. And listen, some people are just very good, just, checking on LinkedIn. They think of someone, they reach
Yes.
out,
Uh-huh.
etc.
Birthdays, just
Exactly.
staying in touch, thinking about it, texting when they're sitting in the airport, text 10 people you haven't talked to in a while.
Yeah.
Yeah.
But that being said, I think one of the things we have to realize is that while all this is well and good, our brains aren't necessarily wired for the modern age. And of course, we could apply that in so many different areas.
Mhm.
But for us,
Okay.
relevant to this, our brain, according to research by Robin Dunbar, shows that we can naturally in our head maintain around 150
150.
relationships.
Yeah.
But how does that work when we are engaging or hearing or following thousands of people? And so that's where I think we need some kind of tooling or some kind of second brain that will say, hey, you really hit off with Greg. It's been a year since you spoke to him, but you really
Mhm.
hit off. Here are some details. He lives in Park City. He runs an incredibly great podcast that you really enjoyed. Why don't you get back in touch with him? Right.
Yeah.
And that's what I believe just a little bit of tooling and intentionality can help you maintain those human to human relationships that are infinitely more valuable than any one transaction.
So that's part of Relatable now, your new software company, relatable.com,
Yep,
right?
absolutely. So it's
Okay.
relatable.one. And
Okay.
the reason being is that after Contact was acquired after a few years, as a common story post-acquisition, they
Yeah.
shut down the public version. So people couldn't access it outside of the acquirer. And I realized I was missing a gap as well as my former customers. I couldn't find anything that worked the way that I knew
Yeah.
and believed that
Yeah.
relationships work. And so that told me all right,
Yeah.
am I really doing this again? And yes, that
Yeah.
being
Yeah.
said, I decided to approach it in a very different way.
Great. Well, I know the founders of ACT that I was part of in the early 90s, the granddaddy of all this relationship software, pre-CRM. used by millions of users. I was part of that. They're thinking about this problem, still, and an unsalesy CRM for relationship people to manage their contacts and their relationships, right? And it's really not about the pipeline and account opportunity, contact, follow up, funnel game.
Absolutely. It's just about staying in touch human to human, right?
Right. And so Contactually had that, let's say, point of view, that opinion. It was an opinionated product, meaning it was about relationships first for the real estate industry. Is that where you were focused or?
Yeah, absolutely. And so while relatable is, I would say like more general and broad for anyone who
Yeah,
cares about
horizontal.
maintaining
Yeah.
relationships, we really knew that, again, we took your advice and we knew that we needed to focus our market. And with Contactually, we said, all right, we are building a CRM that can help anyone maintain relationships. However, in terms of a niche, who are the people who really, really, really care about relationships, not just because they're interested, because frankly, that's how they put food on the table.
Yeah.
And among all the relationship-oriented professions, I would say that real estate agents, rise to the top of the list.
Yeah.
And so we decided very early on, and this is back in 2012, within months of us founding Contactually, to at least focus most of our time
Yeah.
on serving realtors.
There you go. And so how big did Contactually get? Revenue, employees, funding, by the
Yeah,
time
we
you sold
had
it?
just passed around 10 million in annual recurring revenue,
Yeah.
and on an annual basis, and we had raised around $12 million in venture capital before we were acquired.
Yeah, so this wasn't the practical kind of investor capital. This was the old style venture capital, started in 2011. That's what people did. I was out there playing that game as well. So it wasn't so practical. So this is a story about your journey with Contactually as CEO and co-founder and the VC funded growth game, what worked, what didn't, and what you do differently. How many employees did you have when you sold Contactually to Compass? I guess was that in 2019
Yeah,
pre-COVID? Yeah.
we are sold in February of 2019, and we were around 75 employees then.
Okay, great. I know you're kind of in the bootstrapped way these days, but were you very VC funded or were you trying to be judicious about it, in the early days? Like it was exciting. You were clapping when you raised the funding right. And you played the VC funding game.
Yeah, absolutely. And to
Yeah.
be honest, and this may come out, throughout our conversation. I don't want to bury the lead. I'm not necessarily anti VC as
Sure.
some
Yeah.
people go wait online. I believe VC has a time and a place. I'm specifically choosing not to take that path. But when we founded Contactually, what I was bootstrapping it very initially out of the agency I'd built previously.
Hmm.
But we had known that, again, we were three founders, just kind of getting started. Two of us had just gotten engaged. We had bills to pay. We're like, all right, well, it'd be really hard to bootstrap it. And we had
Hmm.
received the offer of funding just almost like out of the blue from a really prestigious incubator. And we said, hey, let's take it. Right. And from that moment, even in the incubator, the focus was, all right, let's help you raise your next
Yeah.
round of funding. And then,
Was
of
that a
course,
Silicon Valley incubator, that
yeah,
kind of
there's
style? Yeah.
500 startups,
Oh, great. Yeah, of
so
course.
based in
Yeah.
Mountain View, California, and they were absolutely fantastic to work with. And,
Yeah.
I would say they follow the typical incubator model or typical incubator model of the time of, all right, in order for a company to get off the ground, they need to raise funding. So
Yeah.
let's make sure and position the company to raise funding. And once you raise funding, then okay, it's in order to prove value, you need to, grow faster. In order to grow faster, you need to think about your next round of funding. And
Yeah.
it kind of, as all of a sudden you
Yeah.
start to see that hamster wheel start to build where everything is about growth to raise the next round of funding, to grow to raise the next round of funding. And, your cap table starts limiting your options more and more.
Well, there's a story in there. So you had started this company. Do you have customers before you joined the incubator, or you had the story and the prototype or the pre-launch product?
Yeah, so we had, I would say, a really ugly MVP,
Oh, okay.
but it was there, right? It was
Yeah.
something that would index your email contacts and start to help you organize and identify them.
Okay.
And I would say, like, I was really excited about it, but for the people I showed it to, we were talking to investors I knew at the time
Yeah.
and different, like, all sorts of different, like, network relationship type people. And we could see that there was a there, right?
Yeah.
Again, it was is a product that, like, I still laugh at because it was so awful and so annoying in the way it worked. But you could tell that people didn't like it, but they liked the direction we're heading, right? It was
Yeah.
somehow striking a nerve in a very different way.
And
And
they
that's
also
what got
liked
us
the
excited.
energy that you brought to this thing. Like, I'm all over this, and so is my team, right? And there's something here. We're going to go get it, right?
Oh, absolutely. I still think, in terms of validating a business idea, someone gave me the metaphor of horse, track, and jockey. There's the horse, which is the company you're building, the track, which is the market, and the jockey, which is the team, including the founder. And
Yeah.
at that time, I was still early in my career, but I had helped a number of startups get off the ground, built an agency, built a number of products. And so, again, the network that I had built kind of had known that I was going to be able to pull some kind of
Ah,
product off. And which is
yeah.
why I knew one of the partners at 500 Startups. And I just happened to be in town showing him the demo. And again, offered for funding right on the spot.
Okay, great. So, incubators, even today, because it's their business model, tend to be gateway drugs to the funding escalator, right? And they offer a lot of help to help you figure out what to do and what to do next, and how to build a product and go to market and so forth. A lot of coaching. Did they get a piece of your company for their help
Yeah,
and that
absolutely.
initial
I would say
investment kind of thing?
they took a
Yeah.
standard incubator deal where they made a small investment in the company
Yeah.
at a very early, like, kind of set valuation, and then for a piece of the company, and then obviously, like, they kept investing through our early rounds as well.
Oh, great. Yeah.
And so yeah, their model was hey, like, we are investing in the hopes of seeing a return. And as we know, how do most companies generate a significant return? It's usually at a liquidity event. So
Yeah. Yeah.
that even then, that from like day one, that put us on this trajectory of like, okay,
Grow fast
this
and sell.
company has to exit in some way.
Yeah. Yeah, a lot of founders don't realize that when they take investment from anybody, their mother-in-law or an institutional fund or whatever, they're committing to sell their company. That's how you pay them back in 99.9% of the cases, right? You have outside investors. They make money when you sell the company. So it's a surprise to a few people with that. But did you ever consider a bootstrap? I know you were newly married and so forth, and this was pretty cool. And cool kids in Silicon Valley were saying you're cool and giving you funding. Did you ever, I don't know, look at the math? That wasn't very common back in the day to 2011, the beginning of SaaS, to consider bootstrapping it. But was that ever a consideration for you?
I would say yes, it was, in that I had a successful agency. We were building
Oh,
out a
okay.
number of products. And so there was the initial
Was that like a
idea.
dev agency? You know how to build modern SaaS products, that kind of thing?
Exactly. I was basically the
Okay.
silent dev partner
Yeah.
to a number of different companies and
There you go.
agencies and startups.
Right.
I'd be the person that you brought in when you're like, all right, how on earth do you build this thing?
Yeah.
And that's when they would call me. So that was the initial view. However, to be honest, I struggled with the discipline. So I had
Ah,
actually a number of startups that I had attempted before that kind of got 90% of the way there in terms of like being built out. But there was always that tussle of like, well, we could keep working on this product and investing time and resources and money, and maybe it'll generate revenue at some point in the future. Or we've got a customer who's willing to pay us money right now for a
yeah.
project.
Yes.
And so there were a couple ideas that I was actually really passionate about, and I still think could have been great ideas that just died on the vine because we never focused. And so I also saw VC funding as a burn the boats moment for us.
Ah, there you go.
That
There you
this is
go.
a way to say,
To get
okay,
out of your services business and the cash flow drug, right?
exactly. Like
Yeah.
we like, and sure enough, like, after signing the docs, we my two co-founders, they quit their jobs.
Okay.
I shut down my
All in.
services business. We went to Mountain View, California. We spent, 3 months like with mattresses on the floor in an empty apartment, like going all in on a new company. So again, that was really helpful. And I think incubators can serve as a forcing
Oh,
function
totally.
to like say, hey, nothing else matters but getting this up and running. That being said, obviously there's, depending on the model of the incubator, and this could ours, VC funding is part of that.
Did you have customers for Contactually initially, like somehow waiting in line to say, if you build it, I will buy it? Or was this a solution looking for a problem, like your own kind of problem, the relationship management thing, and go to my email and tell me who I should be following up with? But what was the initial instigator to get you going in this space?
Yeah, it's a great question. I would say it's somewhere in the middle. We
Okay.
had people who were using the product or trying to use the product, and you could tell that there was a passion starting to build.
Ah. Hmm.
Again, we had a handful of people. We weren't taking credit cards yet, but we would do like these lightweight tests, like put people through like a paywall, and we would see, oh, this person is actually choosing the premium plan that we don't actually
Ah,
offer yet. That tells us, okay, there's at least
they're there
something
then.
there.
Yeah.
Did we have, let's say, like, an initial wait list of people who already put down their credit cards? No. Did we have signed contracts from design partners? Like, no. But
Yeah.
there was, and this is what I'm still grateful for, there was something that was telling us, I think people will want to really use this.
It was a good signal. And it isn't always a line of people, that are putting down credit cards for your MVP, right? It doesn't always work that way, right? Pulling you, that kind of thing. Usually there's this dance of, if I build this, is this really interesting? And you were kind of getting a crowd saying that's really interesting.
Absolutely.
What happened after the incubator? What transformed during your time in Silicon Valley?
Yeah, I would say we went from an early prototype, right, where we said, okay, there's something there. We'd started to like talk to people in the industry. It was up online. And we exited with, I would say, being a real company. We, through that, in that period of time, we had incorporated, we formalized the product, we hired our first employee. We were really starting to like go after customers and influencers and everything
A
like
real
that.
website, a 1.0 product to sell?
Exactly. There was something there, right? Like we had
Right?
built up enough momentum through that like pressure cooker. So by the time then when we returned back to our home base in DC, we were a company, we set up an office space, we
You had the
started.
T-shirts and the hats.
Exactly. We started really going after customers. We were, to no surprise, we were starting to raise like our seed round of capital.
Yeah.
So that was starting to kind of come together, which obviously allowed us to like hire more people. But there was a company. It was something that it wasn't just like, hey, if Zvi just kind of, stops working on for 5 minutes, the business doesn't exist anymore.
And you look like the kind of company who was fundable. Some savvy people in this new cloud market that was bubbling up with real interesting opinions, with 500 startups backing, right? And customers on the way, and you could tell a good story. You're obviously passionate. What did it take to raise the seed funding? Did it take most of your time as CEO?
Oh, let's be clear, it was hell. Uh, for a few reasons.
Yeah.
Number one, and I appreciate that, Greg. I would say I wasn't necessarily the best salesperson at first.
Oh, okay.
I'm
Yeah.
also weirdly, and maybe this is something we'll talk about later. I got very emotional around the investment process.
Mm.
So if an employee quits on me, I'm like, all right, that's sad. We'll move on. If a customer, doesn't like the product, okay, that's fine. We'll learn from it. When a VC or an angel investor like passes on the company, I'm like, oh, I'm a failure. Okay, great.
Oh,
So that obviously made it
interesting.
like very challenging for me to like kind of really run a process and run through it.
Yeah.
At the same time, let's be honest, we had a number of headwinds pushing back against us. We were based in DC, and this is again back in 2011,
That
where
was early.
unless you're in New York or Silicon Valley, like, why would we invest in you?
Mhm.
We were targeting real estate. And as lucrative as the real estate industry is, a lot of like venture investors just did not like serving the real estate world. And we were selling to really small businesses, right? So instead of selling to, let's say, big enterprises with
Yeah.
$50,000 a year contracts, or multi-million dollar contracts as we eventually got to, we were selling to an individual real estate agent paying, at least at that time, like $15 per month, right?
It's
And
almost
so
B2C. I call this B to small b. They're in
exactly.
business, but it's an individual buying it. It's not a team and a company buying it, that kind of thing.
Exactly. And so I'd say we had a number of headwinds that frankly we made it really, really, really hard for ourselves, such
Ah,
that I would say, like, if I were an investor talking to myself back then, I'd be like, I'm not going to invest in you guys.
because it just sounded, hard and messy
Yeah,
or
it sounded
yeah.
hard, just like the selling to very small businesses, like again, B
Yes.
to B, little b,
Yeah.
real estate, DC team, new founders. There are a number of headwinds for us. And again, if horse track jockey, there's a lot of we were creating a lot of friction for ourselves on that.
And you didn't come out of the real estate business, which is a common story. It's a common narrative. I was a real estate agent. I built it for me. I know how to do that. Was anybody on your team out of the real estate industry?
No, not all. Even back then, none of us had even like owned our own home or anything like that. So we knew nothing.
No kidding.
We
Engaged a
decide
real estate agent. Yeah, right.
exactly,
Yeah.
like I would say the focus for us came from, we were initially selling to what I call like kind of the TechCrunch audience,
Yeah. Mhm.
and we knew that in order to go from early adopters to early majority, as Jeffrey Moore in his book Crossing the
Mhm.
Chasm
Mhm.
said, you need to focus on a particular niche. And we
The
saw
bowling
this
pin strategy that Jeff would
exactly.
say, right? You hit the first pin of the 10 pins?
Yeah. And so we saw this really interesting, weird cohort of realtors come on board among the different groups of users. And we're like, we know nothing about real estate, but they're coming on board. They're quickly loving the product. They're paying for it. And, there are a lot of them out there. And then we did a survey of the real estate industry, and we saw that the existing tech solutions out there were pretty abysmal. So we said, all right, well, let's go after real estate agents, at least as a first initial market.
There we go. Yeah, that's right. We'll just do real estate agents first, which is a massive, tricky market itself, right? That old line. We'll start with healthcare, right, or something like that. So that's great. Did you successfully raise a round? As whatever painful as that was to go through that process?
Yeah, absolutely. And you've heard the cliche story of having to say no to a whole bunch of people, or hearing no over and
Yeah.
over and over
Mhm.
again. And sure enough, like that was my case, right? We got no's left and right. But again, at each round, at each time and time again, we got enough yeses that we were able to
Okay.
pull together.
Well, that's pretty much the story of VC funding is you're going to get mostly no's. And if you get a few yeses and a yes all the way to investment, that's what the game is, right? It's like like the marriage game, right? It's not everybody you could marry. It's like you just need one, right?
Exactly. And I mean, and listen, we did fall victim to comparison thinking that there were,
Ah,
for example, companies in our cohort that were able to walk away and instantly raise funding.
yeah.
Are they still around? No, they died. But so just because you're able to raise venture capital and attract interest doesn't necessarily mean that you've built a viable business. But we did fall victim to comparison thing. We're like, well, again, is this something wrong with Zvi, the founder? Like, why is he not able to raise capital, right? Or why do
Yeah.
they hate our business?
Yeah, that's right. Did you raise funding ahead of, let's say, revenues and customers, just so you had to build, as many did, you had to build team to build the product, to build the sales, to build the marketing. So you would raise funding to go build that next round, right?
Yep.
On the way. Yeah. So was that nerve-wracking for you?
Fundraising wasn't what was most nerve-wracking about fundraising was going through this incredibly exhausting process. And then the day after around close, you'd obviously be like, woo, great, we did it. Great work. And then you're like, all right, Now, all of a sudden, the
Mhm.
clock starts ticking towards the next round. And we didn't have, and again, this was a shortage in our thinking at the time, and honestly, even common thinking, but we weren't even thinking about profitability. We were saying,
Of course.
hey,
No, that's right. That's what investment is. Yeah.
we want to grow as fast as possible because fast growing companies are the ones that have the most valuable exits and are able to raise
Yeah.
round of funding. So therefore it's like, all right, how do we light the afterburners even more? Like, let's hire more people, more engineers, spend more on marketing, more on sales. So that was at least our model at the time.
Yeah. Did that work in that round? That phase?
Yes, in that like we were able to successfully raise consistent rounds of funding. However, I would say post our Series A, it became abundantly clear that we were not going to be a hyper-growth company, right?
Okay.
We built a great business. Again, like, when we raised our A, we were doing around 4 million in revenue and
There you
things were
go.
going
Look at
great.
you.
Like,
Yeah.
yeah, we
Yeah.
were
You got up.
exactly.
Yeah.
We were doing really well, but it was kind of growth was looking linear, right? And
Ah,
again, that's not at all a bad thing, right?
right.
Like we were like, again, we in hindsight, I
I'm
look at
sorry to
that.
hear your growth was linear, Zvi. Yeah.
Exactly. I look at our revenue growth chart and I'm great. But again, anyone who studies successful VC portfolios and VC exits, it's the ones that like, kind of like the hockey stick growth.
Oh, yeah.
Those are the ones that really return value. And so we kind of said, there's a bit of a problem here. And again, we made a number of changes to like try and juice the growth. But by the time we were starting to think about our like a further round of funding or Series B, in part because necessity, it became abundantly clear, like, all right, this is not a Series B, C, D, E, go public kind of company.
Like a Salesforce or a HubSpot, in this kind of space. You were this kind of niche player and then real estate and this kind of relationship orientation to it. And it started to feel linear. Was it mostly because it's hard to reach and sell so many, millions of real estate agents? It's just hand-to-hand combat was too tough for the individual, very small business?
Yeah, Greg, it's a really great question. I do go back and like kind of like every once in a while just kind of reflect back about
I'm sure.
whether it was the market, meaning that just there's really high structural churn, and just like people,
It's a
a
really
lot of
tough market.
exactly, a lot of realtors leave the industry or
Yeah.
because oftentimes they're paying for it out of the pocket. If they, hit a little bit of a speed bump, they'll walk away from all their tools, and even brokerages, cycle in and out and have, run into financial issues and are always being acquired. Or was it, our execution? And I would say
Yeah.
it's a mix of both. And obviously
Yeah.
I spent a lot of time thinking about how could we have executed better. And one of the areas that really comes up front is, we've spent a lot of time talking about focus and how we focus on real estate.
Yeah.
I would say we actually did like probably a C- job focusing on real estate. And that was largely
Because
my
you were
doing.
kind of focused, like real estate first, but not only, that kind of thing?
Exactly. Right.
Oh.
And, if, for example, I remember having all these arguments with, our team of saying, hey, I wanted to say like, we're great for real estate and ...
Yeah, I know.
Right.
The dreaded
And if we had really focused on our market and said, hey, we are going to be the best CRM for real estate agents first and foremost, and then we can revisit other markets later on, it might have been a different outcome, right?
Right.
We would have built a slightly different feature set. We might have gone through different partnerships. Instead, every time, for example, there was a real estate specific feature, I was the one jumping and saying, yes, well, can we like make it a little bit more abstract so it could also be generalized towards others as well?
Yeah.
And again, if I believe that like, a leader, above all else needs to be laser focused on like, what, the goalposts are and make sure everyone is lined on it. And in hindsight, I was the one who still had this big vision and couldn't accept that maybe there was a sequence to that vision versus trying it all at once.
This podcast is brought to you by my friends at Fullscale. 2 years ago, I interviewed three-time software founder Matt Watson on this podcast about his successful practical founder journeys. Matt leveraged offshore software development talent in his last two SaaS companies to staff up quickly and grow efficiently. So for his fourth venture, Matt created Fullscale, one of the fastest growing software development companies in any region. Fullscale vets, employs, and supports over 300 professional software developers and testers in the Philippines who can augment and extend your core dev team. I know several practical SaaS founders who use Fullscale's dev talent to make progress on their products and do it efficiently. Visit fullscale.io to learn why their approach works so well for so many SaaS founders. Now back to our program. Well, Zvi, do you think it was I've been there as a marketer in the CRM and space for a long time, contact management. Do you think it was your VC requirement to get this to 100 million in revenue, someday be big, that you looked past just those, awesome real estate market where you could just focus in and double down? A lot of practical founders never think of the once I get past killing it in the real estate market, my home turf, right? I'm going to go on to other markets. You always had this other vision, was that because you had to build a big company that was perhaps bigger than just that first vertical?
Yeah, I mean that's a fair evaluation. I believe that's probably a part of the factor, right? Like
Yeah.
that, the investors that we spoke to, even the investors that invest in us, there's always this, reticence against being against real estate. So there's always the okay, what else afterwards? Even frankly, our team, right? In part because I didn't really
Okay.
focus
Yeah.
the team and say,
Mhm.
hey, this is what we're doing. Even our team was always this like, all right, like let's kind of like think about the other markets that we can go after. And that provided, again, like this continual distraction. So
Uh-huh.
yes, I think, that it was probably obvious also at the time that we were not going to be able to build a big business off
Ah,
of solely real estate. But
there
again,
we
a
go.
good business could have been, 50 million in revenue
Yeah.
potentially.
Just 50 million in revenue. That thing, you're aiming higher than that. What was the hardest part about that growth game from early revenue to 4 million to 10 million? Was it the product side or the go-to-market side, reaching all these very small individual buyers or, team side and something inside the business? What was the hardest part of that growth journey to 10 million?
Yeah, it's a great question. I would say if you were to sit at a board level, right, our number one issue all the time that we spend a lot of time focusing and thinking on was churn. When you're
Oh,
selling B to little b,
yeah.
customers churning out. Again, I look back and saying like, hey, it was primarily just, because there was a lot of structural churn, or
Yeah.
you're selling it
Turnover.
to someone at a conference, and they're like, hey, I really think I'd love to use this, but because they're using it by themselves, there's no like real like push, like a team or company or enterprise like Salesforce, like forcing
Yeah.
everyone to use it. And so I think like churn was a number one issue. But Greg, if it's all right with you, I probably have a different answer nowadays.
Oh, good.
That
Yeah.
I would say the hardest thing was in my own head, in that
Oh.
it hooked us on, again, because we were so attached to growth. Everything was around surviving that quarter, right? Because we had such ambitious growth goals, and from my perspective, ambitious growth needs, right? We
Yes,
need to
right,
grow by a certain
yeah, that's
amount.
correct. Yeah, uh-huh.
Everything was around hitting our quarterly sales goals, and what do we need to do to grind our way, like, just crawl through the mud to kind of
Whatever
get
it takes.
every last
Yeah.
dollar.
Mhm.
And then come July 1st, a brand new quarter roll around and clockwork
Yeah.
and everything goes back to zero. And we're like, great, now we got to start all over again.
Did that
And
create a lot of, I've been through that frenetic, short-term thinking, go, just do this, just do that kind of thing, as opposed to thinking about what's best for the flywheel in a year or so?
oh, absolutely. Everything was around like short-term goals and what we need to do it. And so
Yeah.
even for me as a product person, I spent most of my time focused on sales and marketing, right? And I remember we had we had a live updating spreadsheet on multiple screens throughout the office, and
Hmm.
I would just walk by that multiple times a day, just seeing like, okay, how are we doing? How are we doing? And
Yeah.
of course, like there'll be quarters where maybe 2/3 of the way through the month or through 2/3 of the way through the period, we would like, clearly be on pace to like, to meet or exceed our goal. We'd be like, great, awesome. And times we're like, no, we're never going to get that high. And that made it really, really, really challenging. And it just put us in
For,
that just constant goal.
and I guess it was challenging for you as a founder, right? Did that just play with your head? You just couldn't get out of the, as you call it, that survival trap?
Absolutely. Yeah. So I realized I spent 7.5 years of my life in survival mode. And at no point did I feel that like we were safe and things were fun because we were always, the bank account was always trickling down a little bit.
Yes. Yeah.
We always had growth goals. We're always thinking about how do we get through the next funding round. And again, at no point did I really celebrate like, hey, we built something really
Yes.
awesome. We could like just chill and hang out and, take the team to Mexico for a week or something like that.
No, but you signed up for funding, and the only way to win and not lose everything is to keep up with the growth game.
Yep, absolutely. And I mean, even like, again, we also could have been something different, right? Like we had little glimmers of, reset. So for example, there was a time very early on where we had a lot of product quality issues and we said, hey,
Oh.
we're going to shut down everything and we're going to be laser focused. We call it Red October, like of like
Mhm.
just focused on improving the product. Sales doesn't matter, marketing doesn't matter, everything's about the product. So I believe as a founder, right, sometimes you have to take those big decisions that may be painful in the short term, but like will benefit you leaps and bounds in the long term. And we probably could have like said, told our investors saying, hey, listen, we're going to be making some really hard decisions and, things aren't going to look great for a few months or even a year, but don't worry, we've got the cash in place and we believe that this will work out. There are always decisions that, could have been made that may have improved that.
I think that's a little bit of the trap the VC funded. They don't get to go fix it mid-flight. You don't get to readjust, and I've been part of that as myself. You don't get to do the right thing that'll work out better in 2 years. You just gotta hit the quarterly goals, so forth. How much of your time, this is a useful question for practical founders out there, just to understand, how much of your time through those years as CEO did you spend raising money, thinking about raising money and planning, dealing with board investors and all of that, that if you would have avoided, you would have had more time available, something like that? How much time did you spend on all that of your time?
Overall, probably like, if you were to look at like, overall time management, it'd probably be like
Yeah.
25% of time.
Okay, so it
Yeah.
wasn't 50% of your
No, but
time, but
there would obviously be like crush periods like in a round,
yeah.
where, it'd be 75 to 100% of my time. And that's actually something I still advocate for founders. Like if you are raising money, the best way to raise a round is to raise it really quickly is to say nothing else matters other than raising money right now and basically go into a hole,
Yeah.
for a while.
Darn
And
focus game. Yes.
yeah, and having
Right.
done that since then, and advise others, that's kind of what I say again, like focus on what you need to do. But then throughout, I would say our board was always really supportive and
Oh,
we had a
great.
really great
Yeah.
relationship with our board throughout. But, it always took some time and attention. And there was always, again, that view of like, okay, as with everything happening in the company, how does that get explained and communicated to our board and to our investors and to the larger
That's a lot of
investment
mental.
community
Yeah.
with the next round of funding in mind?
Yeah. So can you share, how much you raised in funding and overall what percentage of the company investors had versus employees and founders?
Yeah, it's a great question. So we investors, we raised around $12 million in capital.
Okay.
And I would say like, again, it's been a long time since I've looked at the cap table, but I would say like
Yeah.
our investors probably owned around 50% of the company.
Okay. And so if you would have kept going, you would have raised more rounds and the founders and employees would have a smaller percentage. I mean, the average, founder employee share of a company when they succeed. The series A, B, C, D, right, goes up and go public, it's like 15 to 20%, but you're kind of headed that direction if you would have sold off more, consecutively bigger rounds, I guess you'd say.
Yeah, absolutely. I mean, that obviously that's with the eye that the overall value of the company would be significantly higher had we raised kind of further rounds of
Yeah,
funding.
right. Yeah.
So it would have netted out that my own share, while smaller percentage wise, would have been more valuable. But yeah, you're taking on more and more and more dilution at each subsequent round.
You and your co-founders were happy to have let's say, a smaller slice of the bigger pie. That was the mindset back then for raising funding. And if you could grow fast enough, there'd be a bigger pie.
Yep, absolutely. I would say that we in terms of like being, rich or being king, we were saying, hey, like we want to make sure that this is valuable for us. We don't need to maintain 100% control of the
Yeah.
company by any way, shape, or form. Obviously, like again, different calculus nowadays. But
Uh-huh.
the idea was that we were trying to build something really valuable. And if I own 2%, but it was worth, $2 billion, great.
Yeah, that's great. So as your company grew from 2011, hit 4 million, raised another round or two in there, when did you feel like we're not going to be able to keep up with the expectation of our investors and maybe we should pivot, maybe we should sell the company, maybe we should do something differently?
Yeah, so it was around 2018 that we raised our Series A in 2015. We knew that we were going to need to raise a Series B in 2018. And it was becoming pretty clear reading the tea leaves that a typical venture scale Series B was likely not in the cards for us, or would be a real challenge just given our growth rate and our size and the
Yeah.
market dynamics at the time. Back in 2018, things were still
Yeah.
very, very weird. And
Yeah.
so it said, hey, it's probably worth putting other options on the table. Again, we had been running this for 6.5 years so far. So
Yeah.
obviously we were getting a little bit tired, surprised, and starting to think. I was even starting to think about, okay, if we raise the next round of funding, like what does the next thing look like for me? The next few years look like for me, and that wasn't, to be honest, as interesting. And so we started again. We were open with the board and started saying, hey, should we also, in addition to raising Series B, should we consider going for profitability, which would be making some hard decisions and letting go part of the team? Should we raise growth equity or take some kind of equity buyout? Should we pursue a strategic exit? And we already had acquirers, including Compass, reach out to us already. So we knew that there was kind of some market interest and
Mhm.
we might be hitting a local maximum. And the board and I decided that, like, hey, let's run a process, right? Let's kind of
Okay.
really like approach and see what options are best, right? Didn't go
To sell the
blinders on.
company. Running a process means, talk to people about selling company, shop it.
Exactly.
Yeah.
Or even like, or selling like kind of a minor equity stake or majority
I see. Okay.
equity stake
Right.
to private or growth equity, or going for profitability. Like we really, and I do credit like my co-founder and I, we really said, hey, let's put all options on the table and collectively decide what is the best option for us.
Okay. Well, collectively, the investors and the, founders don't, aren't always at the same odds of the same result, the same liquidation preferences, but you came to an agreement that, was sensible, that made sense to you and made sense to the investors as well to go shop the company.
Yeah, absolutely. And our investors were frankly honest to us, like that, obviously like your existing investors, they're usually the ones who, be the first to put money in. And again, with their own investment committees and their own needs to generate return behind it, they were very honest in saying, hey,
We can't invest.
maybe this isn't necessarily like the best decision for you or for us to kind of like pursue a Series B. And that kind of signal is very important. And
Okay.
again, I
All
don't
right.
fault them.
Yeah, I get it.
Some people like go and hate on their investors, but you have to realize, investors have their own investors that they're trying to generate returns for, and they're not doing this out of the goodness of their heart. They're doing
Yeah.
this because they're trying to also generate returns for their investors. So it was clear that, like, okay, this is likely not a company that would generate the investment level returns, and so let's run a process and let's look at options.
So you hired an M&A banker and they started shopping it, the whole pitch deck and due diligence and docs and clean yourself up and get on the road, have all those conversations. You do that whole exercise?
Yeah, absolutely. And
Yeah.
to no surprise, I had maintained a number of relationships, and including with Compass and a number of other strategics in the space. And strategics is the common term for other companies that will buy you.
Not just
So
financial buyers that will buy you and don't understand your industry. They're just bigger players in the industry that could leverage your products.
exactly.
Yeah.
And so we're already speaking to a number of them. However, the board and I decided to work with a banker. And I would say a banker does three things. Number one, get your company positioned and help get your ducks in order and docs in order and data group in order to position yourself for sale. Two, they help market you
Yeah.
to not just the people you know, but the people they know as well. And even having a banker signals to people that you are taking this acquisition
Yeah.
process
Mm.
seriously
There you go.
and you are up for sale. So if you are at all interested in Contactually, now's the time to really
Yeah.
start like thinking about it. And three, then they help kind of serve as your Sherpa because I never sold a company before. My co-founder
Yeah.
never sold a company before. My board had too, but like to have someone who's really like just there with us, email it by email, day
Yeah.
by day, call by call to help us navigate this.
It's a little bit like a real estate agent selling your big prize asset, your house, right?
Exactly. It's expensive enough that you don't want to do it wrong.
That's correct. So how did that go? Eventually you sold to Compass, a strategic acquirer there. Did you, have hundreds of conversations, whittle it down pretty quickly, or how did that process go?
Yeah, I would say it's around a 3-month process where
Mm,
we were, again, just, I was on a plane, train all the time to meet with different prospective partners. We had a lot of interest and, we saw
oh,
some
good.
some offers start to come in. And, I do look back and saying like, hey, I'm really proud that like we did run a full process.
Yeah.
At the end of the day,
An honest process. Yeah. Mhm.
we chose, what I believe was the best opportunity on the table, not just for investors and shareholders, but our team and the mission and customers. And
Yeah.
that ended up being Compass. And so it was around 3 months to go from kind of, again, like initial, like starting the process to then having a signed term sheet with one company. And then another 3 months to actually go to closing and have the acquisition, fully locked in.
So Compass, would you say they're in the U.S. here? Were they one of the premium national real estate brokerages? Is that right?
Yeah, absolutely. So
And they have a
Compass
huge
is
platform for their agents. So were they adding this software into their proprietary platform for their Compass agents?
Yeah, absolutely. Compass's vision is to be the best place for real estate agents, especially in the US. And as part of that, they wanted to have the best technology because in most real estate scenarios, real estate agents need to buy their own technology out of
Yeah.
pocket. And one of Compass's offerings at the time was to say, hey, we will give you the technology. That meant they had to build it. And they had raised over $1 billion in funding to kind of build a really great technology team. There was a clear need because the heart of a real estate agent's
Oh my
business
God.
is their network.
Hmm.
And so they were looking for the best CRM. And so they were thinking of build, buy, or partner. They were starting to build it. They then started partnering with us. And so they are one of our biggest customers.
Ah,
And then when we started pursuing a process, they decided, hey, let's not just work with you as a partner, but like consider acquiring you and bring your technology and team and everything like that into Compass.
can you say how much they acquired your $10 million SaaS business for?
Yeah, it's public and I think Compass is S1. I think
Okay.
the overall like price was around 28 million.
Okay. And did that cover your investors and preferences? And did founders and employees get something out of that? It's not a huge win, but it's a win. Yeah.
Yeah, absolutely. And it's funny, like again, selling a company for $28 million, that feels like a pretty good win. But
Yes,
again, when
right.
you're raising venture capital, like, yes, there's dilution and
Yeah.
expectations and everything like that. Everyone made money, right?
Okay.
All of our investors who invest in us made money. Our team made money. I made money. Is it enough that I am talking to you from my yacht in Turks and Caicos? No, but it was enough to say, hey, like, this is a meaningful amount of money. Like, it's a win for everyone.
Yeah.
Investors, were able to put a win on the board and gave myself and the team enough powder to then go start something else at some point.
Okay. And then you stayed on for a while with Compass, this, different kind of organization, and you were that independent CEO. Did you struggle with that like a lot of founders do, or did you enjoy, not having to have the quarterly number in the same kind of way?
Yeah, it's a great question. So, I consider my 7.5 years of running Contactually as business school,
Yeah.
and the 2 years in post acquisition world at Compass as grad school, just
Ah,
continuing my
okay. There you go.
education.
Yeah.
So yes, obviously yes, a lot of things were made a lot easier, like not having to worry about a sales number and being able to be
Payroll.
laser focused
Yeah.
on the product. And having now the new learning experience of being in an organization, and like again, you were kind of like I was a pirate being dropped into the Navy and just navigating that world, yes, was it challenging at times? Absolutely. But it was an amazing education, right? So, for example, I believe very deeply in company culture and we had really great values. And I was able to get a further education in values because I could see how even a slightly different set of values could result in a completely different
Oh,
working style than and expectations for every employee. And like that's kind of almost like one of the best lessons you can get, right?
yeah.
Because I had the same
Yes.
team, the same
I've been through that.
technology, but
Yeah.
now we had a different set of values, and all of a sudden just things shifted. Was it painful at times? Absolutely. But it's those kinds of lessons that, I will never ever forget.
Yeah. Well, let's talk about lessons here. This VC funded SaaS journey from the early days. It wasn't started in 2019, right? With the latest cloud technologies, and it wasn't started in the AI generation. This year. What lessons do you have for founders out there to choose a institutional funding route or the practical funding route and stay away from institutional funding or maybe any funding at all, angel or otherwise? What lessons do you share with people most often? It's not just all VC is bad and you can only bootstrap, but how do you frame it up for founders?
Yeah, no, at all. I would say it comes down to really two decisions, right? One is your company venture backable, right?
Okay.
And most VCs, I have a dear friend who's a VC in the area, and he says most companies that pitch him should not be raising venture capital, right?
Okay. Well, just stop you there. Like, we hear about VC funding and the clapping and we think everybody's doing it. There's a lot of myth around that and perception. But even VCs know that most software companies are not VC fundable.
Oh,
Isn't that
absolutely, right?
interesting?
Yeah,
Yeah,
and
right.
that's fascinating. And they're very upfront about it. Again, they're saying no to most companies, right?
Almost all,
Probably
right.
99% of companies that come through their door, in part because, again, it might be a great team or a great business opportunity, a great market, but there's just not the conviction that this is going to generate the returns that they need, right? And so that obviously causes people to say, "Oh, like VCs are the worst." Like, no, they're just being honest and saying
Yeah, that's the
that
game. That's their
you're
math.
not the right fit
Irrefutable.
for it,
Yeah.
right?
Zvi,
And
would you
again,
say that contextually, looking back, you know, wasn't really VC fundable? It didn't really have the potential to give the big payback of the consecutive rounds of funding or not?
yeah, it's great. I would say the way that we were instantiated, yes. As a relationship CRM, we could have been a great venture-backed company.
Okay.
But for example, targeting individual real estate agents, probably not, right? Had we gone more after teams or said, hey, we're only going to sell to brokerages, or we gone after other markets like mortgage or title insurance, There's other markets that we potentially could have gone to that might have been more
Okay.
stable, more
Yeah.
more value, et cetera. So again, there's many different worlds that you can go after. But I'm gonna be honest, like, and I would tell myself back then, like, I'm not sure you guys should be raising capital.
Okay. Was that your second lessons here? Or is there a certain kind of founder that's aligned with whatever that crazy game is in the modern era?
Yeah, and I would say the other key point, and this is probably the one I spend more time thinking about and talking to people and trying to talk
Mhm.
people out of is, do you want to be a venture-backed founder, right? Because, there are two things that happen once you raise venture capital, right? Number one, you are locking yourself into seeking some kind of liquidity for them. And again, this is not a fault of the VC game
Yeah.
or
Yeah.
angel investors. It is just because that is how they generate returns. So
Uh-huh.
you need to generate a return for them. Are you okay with that? And
Uh-huh.
some people are like, no, I want to build a lifestyle business. I want to build something that I could keep running in 20 years. Well, most VC fund cycles are, 10 years. So no, you need to generate some kind of return for them in one way, shape, or form in the next like 5 to 7 years. And the other is, are you okay having outside expectations? And that was a real killer for me, right? All of a
For you
sudden, because
personally. Yeah.
for me personally, some people are motivated by it. Some people are totally ignorant from it. Me, when someone expects something of me, I would say desire to please them and, and help them put me in this like, okay, I really, really have to make money for them. Right. And again, there's nothing wrong with that, but that put me in this very negative mindset. Some people are energized, like, yeah, of course, like I want to make all my friends rich, right? Some people are like, yeah, like I want to like, prove that like, I can generate huge return. For me, it's like, I really, really hope this works. This really better work, right?
Was that like just a heavy weight, in this journey or a panic or a stress, that wasn't you realized not everybody was experiencing?
Oh, absolutely. It's constant stress. There's this
Oh.
constant like, low to high level stress about it in that like I hope this works, I hope this works, this needs to work, this needs to work, people are expecting this to
Oh,
work.
right. I see that,
Again,
yeah.
weirdly, like not as worried about like myself, my team, my customers. I'm like they'll be fine. It's like we have to make money for our investors. And they did not, to credit them, they didn't never said any of this, right? And again, even our
Uh-huh.
board meetings were incredibly supportive and everything like that. It was just the outside expectations on me.
Mhm.
That's what put me into that weird, weird, weird survival mode.
Well, a lot of founders describe this, and I understand it. I've been there, raised a lot of VC funded and through the years and done it both ways. But a lot of founders describe it as your VC becomes your number one customer, right? And you have customers and employees and sometimes partners, but VCs kind of get the priority because that's the game you signed up for. Was that your experience or?
Absolutely, yes. And
Okay.
just to be clear, they wouldn't say that. They'd be like, "That's
Right.
insane." No, of course, your number one customer, your customers, and the culture and the team. Don't worry about us. Like, build a great company and like we'll profit from it, right?
Yeah.
But again, because so much of the emphasis internally was around generating revenue and generating a return and making sure this works out, and raising that next round of
Yes.
funding.
Right.
Yeah, I mean, a huge amount of my time was thinking about money, 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 money.
Well, you were clear that if you didn't grow fast enough to raise the next round, this wasn't going to work, right? Like it's kind
Yeah.
of like out, right? Yeah, that kind of thing. So it sounds like you did 7 years, 28 quarters of this kind of stressful thing. When you officially sold the company, did you feel a lot of that stress go away? I mean, it wasn't the $1 billion win or anything like that, but did that go away, or did it take years to kind of retool?
Yeah, it's a great question. I'd say I translate this way is I realized I was broken. Like I was burnt out, exhausted. I was, 75 pounds heavier than I am now. Like
Yes.
all of these things, and I just was a hot mess. And at the time, I was married. We had a 2-year-old daughter, and I was just a total just like train wreck of a human being, right?
Oh,
And so yes, like I would say the post acquisition, I kind of like realized this, and that put me on a whole personal growth journey that I've turned everything around and started seeing a therapist and meditating and losing weight and getting in shape and all of these things. But I realized that I just, had just destroyed myself for the sake of the company that, to be honest, wasn't really necessary.
hmm. Is that one of the lessons of your MBA?
I would say so, right?
Yeah.
And I remember getting the advice very early on from one of my advisors that said, just have fun. Just remember, this is fun. And I would remind myself at times that like, hey, this is fun. Like I'm building a company I'm really passionate
Exciting. Yeah.
about.
Yeah. Nice.
I'm working with like really, really, really cool people. This product that I wrote down an idea in Evernote is now like this multi-million-dollar business that people I've never talked to in my life are like relying on day to
Yeah.
day, and it's changing
Mhm.
their lives.
Love that.
That's really cool. But still, like there was still that low level stress and everything like that. So yeah, I listen, some people are okay saying, hey, I'm willing to sacrifice the next 5 years of my life or 10 years of my life for the following 30. Cool. I personally take the view now of like, I would love to enjoy the next 5 to 10 years of my life and the 30 after that and the
Uh,
30 after that. So, hey, let's just kind of like keep building a really great company. And if it takes a little bit longer, fine. But if I'm enjoying what I'm doing day to day, great. I could have taken that mentality back in Contactually, but again,
you
I
did.
didn't know
Yeah.
better. We didn't know
Yeah.
better.
Yeah.
So, okay.
It was a different time. I was also out there raising funding in 2011 and playing that, fast growth game. We got it to 100 million and then not any further. So, similar kind of story and a different stair step there. Well, and you have a smile on your face. You're looking good. You're feeling good. You kind of described the practical founder story, which is, build something and have a life along the way, and you could do it at your own pace. It doesn't have to go to $1 billion in 7 years. So it's very exciting. Zvi, what advice do you give most often to founders? I know you're a balanced advisor here. What advice do you give most often to SaaS founders? I know you're very active in the Washington, D.C. startup and SaaS community. What advice do you give most often when they say, I'm kind of up and running? What should I do next? Should I raise funding? Should I do something else? Should I try to make it big? Should I go all in?
Yeah, it really comes down to like, I would say I oftentimes ask two questions. And number one is, what do you want to do?
Ah, imagine that.
And that's a hard question. You could seem to skip over, but it's like the more you think about it, like filtering out what your family expects of you, what friends, how does it sound to other founders you meet up with,
Yeah.
what VCs are talking about, what's on TechCrunch or X or whatever.
Yeah.
What do you really want to do? And that's not easy, right? Like most people are
Yeah.
not tuned to really understand and think about what they want. And barring that, right, or in addition to that, I would say like a constant question I ask myself that I advise people like whose boards I sit on is, and this is where a board can really help out with, is hey, if they brought a new CEO to your company today, what would they do first and foremost? Right. And again,
Love
like,
that
because we are
question.
so stuck in like our status quo and the ways of working that
Yeah.
if we
Tunnel
asked our
vision. Right. Yeah.
exactly. And if we said, hey, let's zoom out, right? And I mean, one of the gifts of raising capital was it forced me every month to
That's
like
right.
write these
Yeah.
really in-depth investor updates where I would do this like bird's eye analysis of the company. My co-founder and I would really review it. And we'd be like, whoa, why are we doing that thing? That's really stupid,
That is one
right?
of the benefits. Yeah.
Let's fix that like today, right? And just going through that model of like, hey, let's think about what a new company would do, or a new CEO or new leader would do, and that slight shift can get you to make some different decisions.
That's very great advice, and It's a great one for founders to remind themselves, what would it see? A lot of times it's a relief to imagine that. You're kind of in tunnel vision. What would somebody else do? You just get a new set of thinking, and then there's a new version of clarity that you can move on.
Yep.
So it's pretty powerful question there. Congratulations on your incredible journey in this amazing contact management, relationship management, CRM type space that you and I have played in for major parts of our career. I watched Contactually grow and be one of the cool kids out there. It was very exciting to see that. Congratulations on your MBA and your advanced graduate school and all the learning. I know you're a very active supporter of startup founders out there. Do you offer therapy to founders who are, call and might want a little bit of advice?
Oh, absolutely. Like I am still super passionate about the space. So, I seem to be the person that whenever anyone's thinking about anything in CRM or relationship management, somehow my name
Yeah.
gets come up. So I'm really passionate about it. And again, I always have deep respect, right? We've all heard like the man in the arena quote.
Yeah.
I always have deep respect for anyone who's in the arena. And there's that camaraderie and, sisterhood and brotherhood that kind of comes through it. And so I'm always really passionate to like help people out, even if it's unfortunately sometimes it's like, hey, as I had a conversation last night, hey, maybe I should shut down my company.
Yeah. Well, it's not all sweetness and light out there, and it's we climb the wall of all the problems and challenges and do that kind of stuff. And you're still going out there, climbing the next walls there. So, Zvi, thanks for sharing your story on the Practical Founders podcast. It was great to see you.
Greg, thanks so much for all you do on this podcast and for sharing your knowledge and wisdom with others. So thanks for having me.
Thank you. Thanks for watching this week's interview on the Practical Founders podcast. Be sure to like this episode and subscribe to the Practical Founders YouTube channel to keep up with my weekly in-depth interviews with serious software founders who are building valuable software companies without big funding. You can check out my blog, all the podcast episodes, and information about my Practical Founders CEO peer groups at practicalfounders.com, or message me on LinkedIn if you'd like to connect. See you next week.